Well, thank you. It's really a delight to be here. Kevin was talking about some of the things that are driving the growth in impact investing. And what is most encouraging to me is not just the individuals, but institutions that are increasingly looking to reflect their values in their investments as an economic expression. And we see that in folks ranging from the Overseas Private Investment Corporation, which did more than $300 billion in development finance and impact investing just last year, to Seattle University, close to home, for those of you who may have paid attention to what Stanford's doing with its endowment around carbon and coal, those recent announcements. You see religious organizations that want to reflect it in their religious pension fund, that kind of asset management, as well as university endowments. You've got an increasing number of millennials that are interested in a different way of approaching investing. You've got family foundations and donor-advised funds that are looking not just at their grant budgets, but at their balance sheets. And so it's a rich and rapidly growing landscape, and frankly, it's an exciting place to be. So I appreciate the chance to talk a little bit about it today. So I'm going to try to do three things. I am going to, at the risk of, with a knowledgeable group, of trying to define an industry that's just emerging is really complicated. I'm going to put 3 or 4 ideas out for some characteristics that I think capture the state of impact investing. I'll talk a little bit about global partnerships as an example. You'll hear a lot more from other examples, other fund managers today, and hopefully that'll give you a sense of things across the landscape. And then I'll step back and just share with you how we make sense of what's happening, at least at this point in time, and some of the things that we see the most thoughtful impact investors doing. So I'm going to try to do that in 20 minutes or less. Is that right? Okay. Okay, so what is impact investing? There's no clear definition. Here's the 4 things we think about. One is this is going beyond social responsibility practices and beyond screens. So the old world, no alcohol, no tobacco, no firearms, do less harm. And the big shift here is to do more good. So we think about it as simply positive purpose. Any investor that's going to be an impact investor ought to have a clear intention about what they're actually trying to do positively in the world, not just doing less of doing harm. We see it as some combination of double or triple bottom line. So social being people, environment being the planet, and profit. You've got different asset returns, risk-adjusted financial returns by asset class, and you've got different combinations of double or triple bottom line, but in all cases, you're having a double or triple bottom line. And then we see it emerging across asset classes, and I'll talk a little bit more about this, that this is not solely an early stage venture play. You're talking about cash management, you're talking about leveraging the balance sheet with guarantees, you're talking about fixed income or debt, you're talking about public equities, private equities, alternatives, and at different stages. We're seeing it across the board, and I would encourage folks to think about it as a portfolio approach as opposed to a specific type of asset class approach. And we're seeing that across the board in terms of what's emerging. So with that definition in mind, let me spend a minute talking about global and how we kind of fit there so you can place us in the landscape. We're a nonprofit impact investor. We describe ourselves as impact-led, although you'll see the financial performance shortly. Everything we do is investing in expanding opportunity for people living in poverty. So we serve people that live typically under $2 a day in 12 countries throughout Latin America and the Caribbean. That's our raison d'etre. We believe that market-sustained solutions and market-scale solutions are the way to have the biggest impact. So that's how we go beyond screens. Every dollar that's put into an investment fund goes to that purpose. More specifically, in terms of intent, we do 2 things around income generation for people living in poverty. We do 3 things around creating access to basic health information, essential medicines, and health services that folks living under $2 a day would otherwise not have access to. And our 6 impact areas around creating access to solar energy. I'll talk more about that. There are now $10 solar lights and $150 solar home systems that allow very poor families to replace kerosene and wood burning with clean energy with a whole bunch of economic, health, and environmental benefits. So that specifically is the kind of impact we're seeking to have in 12 countries throughout Latin America. We put ourselves in the debt or fixed income or bond asset class. All the work we do in terms of investing are working capital loans to social enterprises in those 12 countries, as distinguished from equity investing. And I'll talk a little bit more about our funds and the bond-like characteristics that we generate. And we're looking at principally social and financial returns. Social in terms of expanded opportunity for the target market that I described. There are some incidental benefits in terms of carbon reduction around solar technologies, but that's not our principal purpose. Our principal purpose is how do you make a positive difference in the lives of people living under $2 a day. So that's where we sit and how we describe ourselves against those emerging criteria in impact investing. In terms of just experience and track record, so we've done 8 funds, we've done 5 funds over 8 years, total of 122 million. So our fund investments have been about the scale of the investments that this network has done. 189 investments, 12 countries, all Latin America and the Caribbean. Our funds are structured for both, your criteria were profitable, actionable, and exitable. All of them are closed-end funds, meaning they have a 5 to 10 year life. There are instruments within them, so investors can basically invest and exit within a 3, 5, or longer term time frame. We essentially construct those so that it has bond-like characteristics. So each of the notes that we offer to investors have quarterly interest payments and then an exit. And our first 2 funds have actually closed. The middle 2 are one's maturing in October, and we've got another one that's already closed and finishing about 24 months, and then one that's open. So if you want to hold it in your head, think about it as quarterly bond characteristics with interest and principal repayment. In terms of results, let me talk about financial and social as one example of a way to do this. So we have across the bottom 5 funds. In 2005, it was a $2 million fund, and we did an $8 million, a $20 million, a $25 million, and our most recent fund is a $50 million fund. There are actually several investors in our funds in the room. I didn't know that coming in here. And essentially, given the risk characteristics of the bonds-like characteristics, we think about this in the fixed income asset class. So our return to investors have ranged from 5.4 up to 6.5. Now we're in about the 4% range. What we do is think about that on a duration match basis relative to underlying T-bills. And you can see the spreads. Everybody in the room, I think, understands that the yield curve has shifted since the global economic crisis. Not surprisingly, the cost of funds has gone to almost to 0. So in fact, our return over duration adjusted treasuries has expanded from about 140 basis points to about 300 basis points over that time period. That's not surprising. Typically, credit spreads decrease over time depending on what's going on with interest rates, but this is how it's played out for our funds. We've had about 107, I think, investors across those funds. Most of them reinvest across funds given the performance, but that's what financial performances look like in the context of the asset class that I described. Our investors range from OPIC, the Overseas Private Investment Corporation, to Seattle University, who's doing a fixed income allocation out of their bond portfolio, to private foundations, to high net worth individuals. So it's across the board of individuals and institutions. So that's how we think about financial performance in the asset class we're operating in. There's an emerging distinction that I'll at least offer up for consideration between impact-led and return-led impact investors. In a nutshell, impact-led investors say, how do I aim at a really big problem, and how do I have a profound social impact, and how do I do that while generating financial returns for my investors? Return-led investors say, I want to generate commercial or asset class specific market rates of return, and I want to do some good while I'm at it. And both are legitimate. We see both types of players in the industry. We would describe ourselves as an impact-led investor. So what does that mean? I'll give you 2 examples. In rural livelihoods and green technology, which are 2 of our 6 impact areas. So aim at a big opportunity. 500 million families do subsistence farming or some kind of farming in the world. They're disproportionately represented in people who live under $2 a day. That's 2.5 billion people at an average family size of 5. So if you can figure out how to get crop productivity up, you address both hunger and income generation for very poor people. Okay. What we found is when you actually go and work with farmers, 3 pretty simple things drive up productivity and yield. If you get working capital to farmers, let's say a coffee farmer, so that they can actually finance their crop and finance their family through to the harvest cycle. If you bring them technical assistance on how to grow the coffee, how to do the right shade cover, how to grow it the right way, not surprisingly, yields go up, crop diversity goes up, and quality goes up. And then if you simultaneously give them access to commercial markets, typically pre-negotiated access to commercial markets like organic and fair trade, you can get higher prices. So if you can help them grow the crop better, grow more of it, grow it more stably, grow it in a more diversified way, and also get them better access to markets at higher prices, not surprisingly, you see income generation happening at that family. Since that's our objective, that's how we think about impact in that case. Another example would be access to solar technologies. Typically, families, 1.3 billion people are living off the grid. These solar technologies that I described earlier, which looks like either a single light that looks like the one in the picture, or a small panel with 4 lights and a cell phone charger that costs about 120, 150 bucks. If you can get a family to switch from kerosene or firewood to a solar light, you see 5 or 6 things happen. First, they save money. So the solar light costs about half. The energy costs about half as what it does to burn kerosene and firewood. You get smoke out of the house, which has immediate health benefits. Upper respiratory disease is a big issue for children. You improve the safety in the home, because when you burn kerosene and firewood, you burn a lot of houses down. The quality of light goes up into the evening, so you get better study time and better work time at night. And you have an incidental benefit that you just reduce the carbon footprint. So we would look at that and say, in each of these cases, there's a huge opportunity for the people we're here to serve. There's a specific, researchable, and defensible case for it having positive impact. Let's focus our resources on initiatives that look like that. That's what we mean by impact-led when we do investing. In terms of how we think about social impact,